Crypto just dumped again. Red candles across the board. Ethereum is down, headlines are flashing war, and over $1 billion in leveraged positions were wiped out all in under 24 hours. But here's what most people won't tell you. While retail was panic selling, institutions were quietly loading up on ETH. And not just because it's cheap. There's a much bigger play in motion. My name is Danilo, and today I'm breaking down exactly what happened, why smart money is buying Ethereum right now, and how you can position yourself before the next wave hits. If that sounds interesting to you, make sure to hit that subscribe button and ring notification bell so you never miss future crypto updates. Alright, let's get into it. Ethereum didn't crash because something's wrong with Ethereum. The entire crypto market dipped as tensions exploded in the Middle East. Israel launched airstrikes against Iranian military and nuclear sites, and in response, Iran has vowed to retaliate. Global markets reacted immediately. Oil prices spiked, stocks dipped, and in crypto, the fallout was even faster. In less than 24 hours, over $1 billion in leveraged positions were liquidated. ETH dropped by more than 6%. Bitcoin slipped under 103,000. Solana, XRP, absolutely everything took a hit. But here's the part that matters. This wasn't a breakdown of fundamentals, it was a fear-driven flush. Risk assets tend to sell off during moments of uncertainty, especially with this level of geopolitical tension. And because crypto trades 24/7, it reacts before anything else, even before the stock market can open. Traders panic, stop losses trigger, leverage unwinds. That's just what we saw. And if you've been around the space for a while, you've seen this pattern before. During the Russia-Ukraine invasion, Ethereum dropped sharply on day one, only to rebound weeks later as the dust settled. In the March 2020 COVID crash, ETH fell below $100. Then, it ran to nearly 5,000 the following year. These moments feel chaotic in real time, but they rarely change the long-term trajectory. Ethereum doesn't stop functioning when global tensions rise. Blocks keep finalizing, the network keeps running. So while most people were focused on the red candles, something much more important was happening underneath the surface, and it's the part retail usually misses. That's what we're getting into next. While retail was panic selling, institutions were doing the exact opposite. Over the past week, ETH spot ETFs saw more than 530 million in inflows, 5 times higher than the recent weekly average. On June 11th alone, over 190 million flowed into ETH ETFs in a single day. These aren't degen traders buying the dip. These are asset managers, funds, and long-term allocators making a deliberate move into Ethereum during one of the most volatile news cycles of this year. BlackRock's iShares Ethereum Trust led the charge, bringing in nearly 100 million in a single day. At the same time, total assets under management across crypto funds hit a record high of 167 billion. Ethereum isn't being ignored anymore, it's quietly being accumulated, strategically. Now, it's worth noting that inflows briefly paused on June 13th, breaking a 19-day streak. That's not a red flag. If anything, it suggests accumulation is happening in waves, and smart money is choosing its entries, not blindly chasing all the green candles. But let's take a step back. ETF flows aren't just raw numbers, they're one of the clearest ways we can measure institutional sentiment in real time. When funds are flowing into a regulated vehicle like an ETF, that tells us investors aren't just speculating, they're allocating. ETH ETF inflows signal long-term conviction and not short-term hype. And in the past week, those flows into ETH have actually outpaced Bitcoin on a relative basis. That shift matters. For the first time, ETH is starting to pull ahead in narrative momentum, and not just as a complementary asset to Bitcoin, but as a standalone investment thesis. That's a turning point, and it's happening while most people are distracted by all the headlines. So why Ethereum? Why are institutions choosing to buy ETH during uncertainty instead of just rotating into Bitcoin or sitting in cash? It comes down to how ETH is evolving and what it actually powers under the hood. Ethereum is no longer just a platform for DeFi and NFTs. It has become a foundation for stablecoins, tokenized assets, and the next generation of financial infrastructure. Most of the world's stablecoins live on Ethereum. Major banks and corporations like Deutsche Bank are now building layer 2 networks on top of it. Asset managers are issuing tokenized treasuries and real-world assets directly on Ethereum. Franklin Templeton, for example, runs a US government money market fund fully on-chain using ETH. And BlackRock's new tokenized fund also lives on Ethereum's infrastructure. This shift isn't theoretical anymore. It's already happening, and ETH is what powers all of it. Every tokenized asset, every L2, every rollup requires ETH to settle or interact. And that's why institutions are beginning to recognize it for what it really is. Not just a speculative asset, but economic infrastructure. That's where the digital oil thesis comes in. If Bitcoin is digital gold, a passive store of value, Ethereum is the fuel that powers an entire ecosystem. It's not just held, it's being used. And importantly, it's neutral. In a world where different jurisdictions, banks, and blockchains need a way to transact with each other without centralized intermediaries, ETH serves as shared collateral. It's permissionless, censorship resistant, and always available. Traits that become more valuable the more interconnected the digital economy becomes. And here's something that makes it even more appealing to institutions. Ethereum is now energy efficient. After the merge, its energy usage dropped by over 99%, making it one of the greenest blockchains in the world. For ESG-conscious funds and corporate treasuries, that matters. So, when you combine real-world utility, regulatory momentum, and an improving sustainability profile, ETH starts to look like less of a tech token and more like digital infrastructure with asymmetric upside. Another reason institutions are taking Ethereum seriously is because it's not just a buy and hold asset, it's productive capital. Right now, over 34 million ETH is staked, which represents nearly 28% of the total supply. And that number keeps rising. Unlike Bitcoin, which just sits in cold storage, ETH can be staked to secure the network and earn yield. And that yield matters, especially in a high rate environment where capital is expected to work. But the way you stake ETH has evolved. You can stake natively by running your own validator, which requires 32 ETH and some technical setup. You can stake through centralized platforms like Coinbase or Binance, where the trade-off is convenience versus custody risk. Or you can go the liquid staking route, using platforms like Lido, Rocket Pool, or Ether.fi. These protocols issue tokens like STETH or RETH that represent your staked ETH, and you can still use these tokens across all of DeFi while earning rewards in the background. For institutions, this liquidity unlock is a game changer. Maple Finance, an on-chain credit protocol, recently partnered with Lido to offer stablecoin loans backed by STETH. That means capital that's earning yield can also be used as collateral, just like how treasuries function in traditional finance. This isn't just a staking strategy anymore, it's a capital efficiency strategy. And keep in mind, there's even more coming. ETF issuers are now exploring staked ETH products. If approved, these funds would offer both price exposure and staking yield in a single regulated vehicle, perfect for institutional allocators who want passive yield without ever touching DeFi. That's a massive leap forward, and it's one more reason institutions are quietly building ETH exposure now, before the rest of the market catches on. While institutions are staking and accumulating ETH behind the scenes, traders are moving in aggressively too. Ethereum recently surpassed Bitcoin in perpetual futures volume, accounting for over 45% of total activity across all major platforms. That's a big shift. It shows that even in short-term, high-leverage markets, Ethereum is becoming the asset of choice, not just for long-term holds, but for trading strategies, hedging, and directional bets. That kind of dominance in derivatives markets signals deep liquidity and high conviction. It also shows that ETH is no longer riding on Bitcoin's momentum. It's moving with its own market structure, its own narratives, and its own user base. And now, Coinbase is making it easier than ever for the next wave of users to access that on-chain ETH economy. They recently announced that Base, their Ethereum Layer 2, will be fully integrated into the main Coinbase app. That means millions of retail users will be able to buy tokens, interact with DeFi, and explore the Ethereum ecosystem without ever leaving Coinbase. No new wallet, no bridging, just tap and go. Base has already been one of the fastest growing ecosystems in crypto, and it's largely driven by consumer demand. Everything from meme tokens and on-chain games to DEX trading and airdrop farming. Tokens like Degen, Toshi, and Mochi are gaining traction on Base, and Coinbase's integration now gives retail users a direct line to these assets with almost no learning curve. That's a huge unlock. For ETH, this means more activity, more gas usage, and more long-term demand, not just from traders or institutions, but from everyday users who now have a frictionless path into Ethereum's Layer 2 economy. So let's bring it back to you. If you've been watching the charts and feeling anxious, that's normal. But here's what separates long-term winners from the crowd. They don't react emotionally. They look at the signals, and the signals right now are clear. Institutions are accumulating, ETH staking is hitting all-time highs, retail access is getting easier, and derivatives volume is surging. This isn't a market that's collapsing. It's one that's setting up for its next big phase. If you believe in Ethereum's long-term upside, this kind of pullback isn't something to fear. It's something to use. Whether that means dollar cost averaging into ETH, allocating through ETFs, or staking to earn yield, the key is having a plan and sticking to it. You don't need to time the bottom. You just need to stop selling into the panic and start thinking like the people who are already winning. And if you're not sure where to start, don't overcomplicate it. You can buy ETH through an exchange like Coinbase or Kraken, stake it directly or through something simple like Coinbase staking, or even get exposure through an ETF if you want to keep it passive. The point is, you have options, and more of them than ever before. And if you're still not ready to take action, at the very least start tracking the right signals. Use tools like DeFi Llama to monitor TVL flows, Dune dashboards to follow staking and ETF inflows, or L2Beat to see how quickly ecosystems like Base are growing. When you start paying attention to what actually matters, you stop getting distracted by what doesn't. Listen, here's the bottom line. Ethereum didn't crash because its fundamentals broke. It dipped because the world got scared. And in moments like that, the smartest investors don't sell. They buy, they stake, they accumulate. Whether it's through ETFs, liquid staking, or direct exposure, they use volatility as an opportunity to build. Retail always focuses on price. Smart money focuses on position. So the next time fear hits the market, ask yourself, am I reacting to noise or am I following the real signals? If this video helped you see the bigger picture, give it a like and drop a comment below. And if you want more breakdowns like this, hit subscribe and ring the bell so you don't miss what's coming next. Thanks for watching, and I'll see you in the next one.